Okay, I want to refresh a little bit of your memory for Chapter 8, what we covered 2 weeks ago on Wednesday. We started Chapter 8, the first part on receivables, and specifically the topic on uncollectibles. Okay, the core of this chapter in the first part is that we want to estimate potentially the part of accounts receivables that will not be collected from customers. Meaning that, remember, earlier in Chapter 5 and 6, we talked about making sales, merchandising operations. Earlier in the first 4 chapters, we talked about service revenue. 5 and 6, we talked about sales revenue. And in terms of gaining revenue, companies either directly collect cash or they consider making sales or service revenue on account. So this will increase accounts receivable. So there's actually a risk for doing sales or services on account. The risk would be that customers may not have enough fund on hand. They may promise to pay you the money in a certain time frame, but if they miss the time frame, that becomes uncollectibles. Okay, so before companies actually deem certain accounts as uncollectibles, for public traded companies, for GAAP, they always highly recommend companies to do an estimation using allowance method. Okay, so there are 2 methods to account for uncollectibles, to account for some of the customers if they missed the due date and they didn't pay the money, how companies will take care of those transactions. This is the one recommended by GAAP and used by public traded companies, allowance method. Okay, last Wednesday we talked about allowance method, and this breaks down to percent of sales method and aging methods. Okay, so both of these methods are under allowance method, meaning that we want to do an estimation of possibly what are the amounts of accounts receivable that we will not be collecting. Okay, so this is the core of the first part of Chapter 8, accounts receivables. We use 2 methods to account for uncollectibles. This is the one used for public traded companies. This sometimes is used for small businesses or non-public traded companies. Okay, so under allowance method, we'll be using companies can use either percent of sales method or aging methods. Some companies may want to use a combination of both. Both of these gets to this journal entry. They're just different ways to do it, different ways to estimate the part of uncollectibles, but they both get to this first estimation entry. Okay, so the first part of Chapter 8, there's 3 core entries here. We want to do an estimation of uncollectibles, meaning the part of accounts receivables that companies are not collecting on time. We want to write off some of the bad debt customers' accounts once those accounts are deemed as bad debt accounts, meaning after it's past its due date, after companies tried very hard to contact customers to get the money back, but they failed, then when they turn those cases to their attorneys or debt collection company, then companies at the same time would write off those accounts receivables. Now, after writing off, some customers may have enough cash later on. If they recover the accounts receivables, they actually pay back the cash back to the company, then we need to flip this entry, basically reversing what we wrote off earlier. Okay? So let me just go through these journal entries again. For percent of sales method, we estimate uncollectibles based on this example here, $15,000, which is the total amount of credit sales. Now keep in mind that the $15,000 do not include cash sales, because the whole purpose for this chapter is to account for some of the on-account sales that will not be collected. Okay, so if a problem tells you that there's $2,000 of cash sales, $15,000 of credit sales, we estimate the part of uncollectibles only based on $15,000. So not based on any amount of cash sales, because we readily collected it by cash directly when we made that transaction. Okay, so percent of sales here, if this season total we made sales on account, $15,000, by prior year's experience, companies estimate that there will be about 2% of these sales that company would not be able to collect from customer either on time or at all. Then altogether, we make this journal entry of estimation $300 as uncollectible account expense. So this is before we actually determine what are the accounts that has been past due. This is an estimation up front. Why? because we want to match up with the revenues that we gained from earlier, the sales transaction or service transaction. Remember matching principle? We always want to estimate we always want to record and recognize expenses that occurred in that season. This is one of the expense that relates to making sales on account. So there's a possibility that we will not be collecting a portion of the money on time, and we estimate this expense up front before it actually happens. Okay, this also aligns with one of the principles that we talked about in Chapter 6. Remember conservatism? So what is conservatism about? Remember in Chapter 6 we talked about inventory methods, we talked about materiality, conservatism, consistency, disclosure. Conservatism is one of the principles that guides accountants to always estimate the highest possible level of expense and liability under cases of uncertainty. Okay, so this is one of the cases that you make sales on credit, on account. You're not sure whether you'll be actually collecting the full amount on time. So before we actually determine some of the bad debt customers, we always want to estimate upfront highest possible level of expenses. So this is one of an example. Okay, so this is percent of sales method. We estimate this $300 based on credit sales. Another method that companies can use is aging of accounts. So aging of accounts, this chart here, we talked about this last Wednesday also. We will break down accounts receivables based on its age. So you see this column here, there's about $1,800 of accounts receivables that are brand new, that are just a month old. There are about $200 of accounts receivables here that's 2 months old. $340, 3 months, $400 that is over 3 months old. So the longer the accounts receivable stays there pending in the business, the higher the possibility that it will not be collected later. So usually if it's more than 3 months old, it definitely has been past due for some time already. So usually accounts receivables lifetime is only about a month to a month and a half. So if these are the accounts that are still pending there, still outstanding there on the business financial statements, then these typically are the money that will have a high possibility that will not be collected later on. Okay, so we total up based on the age of the accounts, we assign the percentage of uncollectability, and we times these two numbers, add them together to determine a target uncollectible balance. Okay, so the one way of measuring uncollectibles is using credit sales. Another way is using the age of accounts. Okay, so this is based on the age of the accounts. This is the total amount of young accounts receivables. This is the total amount of old accounts receivables. And then we times the uncollectible percentage, that we add them up to get to this $400. Okay, so once we reach this $400, this is the total target uncollectibles that, the highest possible level uncollectibles that we will possibly get for the company this season. We compare this 400 with what is already there in the account earlier. So the last year's balance was 150 on the T accounts there. This year's balance, we estimate the total uncollectibles worth $400. So when we journalize this entry on uncollectibles, we only journalize the differences $250. Okay? Again, earlier we used this aging of accounts. We figure out a target uncollectible balance. But remember, accounts receivables, allowances for uncollectible accounts, these are permanent accounts. So it's not like we zero them out. We only zero out revenues and expenses. So meaning that last year, as long as the business has readily started before, we definitely have a balance under those two accounts already before. So we compare this $400 with earlier what was last year's balance, which is 150 in this case. And the difference is the part that we additionally estimate as this year's uncollectibles. Okay, so keep in mind that that 400 is not used for journal entry. We only journalize the additional uncollectibles because earlier we already have a balance of $150. Now we just add an additional $250 as additional estimation for this season's uncollectibles. Okay, so after this estimation, that box there, net realizable value $2,400, that represents you can think of it as the part of the accounts receivable that really would be collected, the highest possibility that will be collected. Earlier, the total sales we made is $2,800, but we recognize that a part of it, based on prior year's experience, we may not be collecting it on time. So really, the realizable value of accounts receivable is only $2,400 after subtracting the $400 uncollectible balance, allowances for uncollectibles. Okay, I'm just reviewing the main parts that I covered last Wednesday, so you know where we'll continue on the topic. All right, so far what we covered is this: uncollectible accounts expense and allowances for uncollectible accounts. This basically is an estimation on, just realized I misspelled this. Basically is an estimation on the part of credit sales that we did in this season, and a portion of that will not be collected on time or will not be collected at all. So after this, what happened is that when it gets to next year, beginning of next year, companies usually will evaluate the accounts receivables and make sure that some of them, if they're still within, before the due date, of course, we don't do anything about those. But for the accounts receivables that has readily passed due, and after several attempts of trying to collect them, if company failed to do that, we'll be writing off those two bad debt accounts in this example. Okay, so meaning that Andrew's accounts, Jones' accounts in this case here, has passed due already, and companies decided to transfer the case to attorneys or debt collection company, they'll be reducing accounts receivables accounts for these two customers. Okay, this entry here doesn't mean that they don't have the responsibility to pay the money back later on. They still do, but we don't want to mislead outside users of financial statements stating this on accounts receivable, because in reality, there's a high chance that we'll not be collecting it. Okay, so this write-off entry basically reduces accounts receivable with some of the past due accounts, and we use this pool that we did earlier, that we created earlier as allowance for uncollectibles. We use this pool of allowance to assign it to the bad debt customers, writing off, identifying bad debt customers here. Okay, so this part here is the second entry. After estimation, before we identify bad debts, this is an estimation entry. Second here, when we actually identify the bad debt customers, the ones that has past due, we write off their accounts receivables and use up the allowance pool that we estimated earlier. Now, some cases, some companies may probably just stop here. If later on Andrews and Jones do not pay the money back later, perhaps they don't have to recover their account at all. They will be continually pending at the attorney's office or debt collection companies. But in case that later on customer do have enough cash to pay back the money, we want to erase this entry of written off entry by reversing it. Okay, recovery of accounts represent that earlier we wrote off the entry, now we want to flip the account back since customer now has enough cash and are ready to pay back the money to the company. Okay, so this recover entry involves two steps. The first step really is just erasing what we did earlier, flipping the entry that we did earlier for allowances and accounts receivables, bringing back accounts receivables here. Okay, that's the first entry. So these two entries only happen when later on this customer that you previously written off have enough cash to pay back now. They come to you, pay back the money, we reverse the previously written off entry. Second, just a regular cash collection on account. Any questions so far? So this is actually the most complicated case for accounts receivables. In most of the cases, if, let's say, your customers are actually all paying the money on time, then you don't have to write off anything, you don't have to recover anything. Companies would just be estimating potentially the uncollectibles. Meaning if this season all the customers are doing well, they all pay back the money within a month or a month and a half, you don't have to write off anything because you don't identify bad debt customers. And then later on, of course, if you don't write off anything, you don't have to recover them. So that will only be this entry. This case here tells you that in case customers do have past due accounts, they passed the due date, you tried to collect it, companies tried to collect it, but they failed, they write off their account by reducing accounts receivable. And if later on customers pay back the money, then you recover their accounts. Recover means collecting the cash, but before you do this, you want to erase previously the written off entry just by flipping it. Okay, so this is the most complicated case that could happen. Okay, so in summary of all those entries, this is actually extracted from the textbook, so you can also find these entries on the textbook, one of the tables. The blue ones are the ones that we introduced in this chapter. The black ones are the ones that you readily know what's going on there. So meaning the first entry, that basically is providing service, providing sales on account. You just debit accounts receivable, credit sales, debit accounts receivable, credit service revenue. Second entry there is newly introduced in this chapter. You do an estimation of uncollectibles based on percentage of sales. Remember that $15,000 of credit sales times 2% of uncollectibility that you estimated from last season. Okay, normally most of the cases in the middle you will have cash collections on accounts for most of the entries. Some cases, if you have bad debt customers, then you identify them and write off their entries, write off their accounts. So this is the middle one here, write off accounts receivables. So that basically is exactly the same as what I've written here. Okay, the fourth one, if companies decide to use aging of methods, typically at the end of the year they will make a chart of all the accounts. Remember, break it down by the age. So this is what this entry is representing. Again, percent of sales and aging, they both get to estimation. They have the same purpose, just different ways to do an estimation. Okay, and the last one here, the most complicated case, if customers pay back the money later, will recover their allowance account, bring back accounts receivables, and then reduce immediately because we're collecting cash from them. Okay, moving on to direct write-off. I'm just going to briefly go over this because this is not really recommended by GAAP, but you still have to know that some of the small businesses uses this to take care of uncollectibles. So up to now, what I covered so far is allowance method. Allowance means that we make an estimation, set a pool of allowances for uncollectibles up front. So the main difference between this allowance method and direct write-off is that this method here do not do an estimation before. Okay, meaning that it only writes off the accounts for Andrews and for Jones. Remember, these are the two bad debt accounts. They write it off directly when companies deemed as these accounts as uncollectible accounts receivables. So they do not have this first estimation entry. They start from here, writing off, which is why it's called direct write-off method. Okay, so some of the small businesses, because making all these journal entries in a way is a little bit more costly for them, so they would just directly write off Andrews and Jones, the bad debt accounts, whenever they determine that these are the accounts that pass due, and then consider these as uncollectible account expense. Okay, so the difference is that they don't have this entry, and also for this write-off entry, they're not using an allowance pool. They just use uncollectible account expense debited and credit accounts receivables. So the problem for this method, the reason why GAAP is not recommending it, is because notice that the time frame here, usually some of the accounts, because credit sales or credit service revenue has been constantly happening in the business on a daily basis, when it reaches the end of the year, if some of the accounts, some of the sales has been made close to November or December, when we realize it's past due, oftentimes it's the following accounting period. Okay, so meaning that these accounts receivables are related to the sales and service revenue that happened last year, 2014, but we only determine them as past due 2015. Okay, so these crosses to different accounting periods and would violate one of the principles that we talked about, we have been talking about a lot, matching principle, because this uncollectible account expense should have been identified last year. It relates to last year's sales revenue or service revenue, but we only wait until it's past due to identify this. So there's a matching principle violation here. There's also accounts receivable overstatement for last year. Okay, under this method here, if we estimate uncollectible expense up front, Andrews and Jones accounts, even though it's bad debt, it will be the uncollectible expense will be recognized in 2014 instead of 2015. Okay, but under direct write-off, they don't do this estimation. They just recognize it as it happens. When we realize there's bad debt customers, then we write them off. We don't do a pool of estimation based on prior year's experience. So it doesn't align with conservatism principle, it doesn't align with matching principle. And also, if we look at 2014's financial statement, you will find accounts receivables overstated because these two accounts was not being wrote off earlier. Okay, so direct write-off, the reason why we're not using it is because it violates these principles. It doesn't do an estimation up front. Okay, but it's very risky because some of the accounts may be past due until next season. So you will have expense estimated in 1 year and sales revenue recorded last year. Okay, remember matching principle, we always want to estimate in this accounting cycle the expenses that happened and then subtract it from this year's sales revenue or service revenue. In this case here, if uncollectible account expense was recorded next year, but it really relates to last year's service and sales, this is one of the principles that is violated using direct write-off method. Okay, now under direct write-off, once the company decides which are the customers are bad debt customers, when they write off that entry using uncollectible account expense, reduce accounts receivables. If later on, again, if the customer has enough cash to pay back this accounts receivables, we also want to recover these accounts. So in terms of recovery, really the concept is very similar to allowance method. Again, we're flipping the previously written off entry and then journalizing a regular cash collection entry. Okay, so this last step here is exactly the same as this recovery entry here. The concept is exactly the same because we're trying to erase previously the written off entry. So under direct write-off, we also want to erase this. We will be flipping this and collecting cash, reducing accounts receivables. Okay, so this reverse entry here, recovery entry also has two of them. Accounts receivable increased and then immediately decreased because we're collecting cash. So in the case of direct write-off method, if all the customers are paying money on time, then basically you will not be identifying anything. You'll not be writing off any accounts receivable accounts. You'll not be recovering anything. So under direct write-off, if all the customers are paying on time, there will be no journal entries to be recorded other than sales revenue on accounts, service revenue on accounts. Earlier that transaction happened. Later there will be nothing recorded under the case of direct write-off. But allowance method, even though all the customers are paying on time, we still do an estimation just to be more conservative. Okay, this estimation entry always occurs for allowance method. This is the whole purpose of allowance method. Okay, we do an estimation up front. Okay, any questions for these two methods before I move on to notes? Okay, the core of this first part is that we want to make sure that companies represent on financial statements the appropriate amount of accounts receivables. That's the whole purpose of doing this. Okay, because a part of it we noticed from last year's prior year experience, a part of them may not be collected. So we estimate them based on total amount of credit sales or the age of the accounts. So this estimation always happens first, and typically it's on a monthly basis. At the end of the month, companies will do this estimation based on % of sales. And then they combine with this last method. Usually this happens at the end of the year. You will prepare a table of all the age of the different accounts receivables. Okay, then later on we'll be identifying the accounts that are past due, that we did not collect from customers on time. And then when companies transfers these cases to their attorneys, they write off these accounts receivables, just so that we don't overstate accounts receivables on the statements. Later on, in case customers pay back the money, then we recover the accounts. Okay, so there's really 3 steps to this. Under direct write-off, there's no estimation. Just by its name, we only directly write off the accounts when we identify bad debt customers. Okay, once we identify them, write them off. Later, if customers do have money to pay us back the accounts receivables, then we erase previously entry by flipping it and then do a regular cash collection entry. Okay, these are just some of the cases that may happen. The majority of the accounts usually will be collected after you make sales and services on account. Later on, customer just pay back the money on time. You just have this entry, cash collection, accounts receivables. In some cases, you may have bad debt customers. You have to recover the entries. This is what would happen for those cases. Okay, let's move on to Notes Receivables, the other part of Chapter 8. So accounts receivables usually has a shorter lifetime compared to notes receivables. Usually accounts receivables are due within a month or a month and a half, but notes receivables could be made for a number of months or even a year or even more than a year, right? It could be a short-term note if it has a lifetime less than a year. It could be a long-term note if it has a lifetime longer than a year. So really it depends on the two parties, depends on their agreement. If my company decides to lend money out to another person, we talk about the time frame and we both agree on a year period, then this would be a year long of notes receivables. Okay? Some companies may decide to make sales to customer and they agree on also signing notes receivable instead of accounts receivable. This will give customer longer time to pay back the money, but also would involve interest. Okay, so the main difference for notes receivables and accounts receivables is that this is more official in terms of they have an official promissory note document that both parties' name will be on it, and also interest will be involved for these cases. So notes receivables always, later on when your company is collecting the money, you're not just collecting the original amount, but also a portion of the interest based on how long the note's lifetime is. Okay, so for this case here, we'll try to understand this promissory note here. You see the principal amount is $1,000, meaning this is, for example, in this case here is that Greg's Tune is the company lending out money to this customer called Holland, $1,000, on the date September 30th, 2014. Okay, so September 30th, 2014, on the right-hand side is the date this transaction happened. And the dollar amount that Greg's Tune is lending out to others is $1,000. So that $1,000 is called a principal amount. Principal amount is other than interest. Okay? Interest is added to principal amount. Together it becomes maturity value. Oops, sorry. So you have principal amount, just the original money that the creditor loaned out to others, or the original amount of the inventory's worth if you're trying to make sales to customer. Then you add interest. This will give you the total maturity value. Okay, maturity value at the end is the total amount that debtor needs to pay back to creditor, including principal amount plus the total amount of interest. Okay, so can anybody tell me how will we be able to calculate interest here? Do you find percentages information here? Interest percentage. 6%, and this is an annual rate of interest, meaning that if you look at this promissory note here, right-hand side is the date that we created it, 2014. This is the due date, maturity date of the note, meaning the final date for this debtor to pay back to creditor the amount of money of $1,000 plus 6% of interest is a year later, September 30th, 2015. So this is a one-year note, and this one-year note is based upon $1,000 of principal amount that Greg's Tune lent out to others, and also 6% of interest Greg's Tune later on will be collecting from Holland customer. Okay, so the 1,000 plus 1,000 times 6% will be the total maturity value here. 6%, we'll need this 6% to times principal amount. So 6% times 1,000 will get you how much? $60, right? So the total maturity value here will be $1,060. This is the amount that Greg's Tunes will be collecting on 2015, September 30th. Okay, this is a simple example. Later on we'll go into other time frames. Different time frames will have a different way to calculate interest. Okay, so in terms of maturity dates, the maturity date could be set by both parties based on months, last example was a year, or it could be number of days. Okay, so If it's based on year, just like the previous example, September 30th, 2014 was the beginning date of the note, then if it's a year note, then you don't change the month or date, you just add another year, 2015. If it's based on month, again, you don't change the date, specific 30th, the date, you just change the number of months. So meaning if it's September 30th, 2014, and it's a 3-month note, then it will be due October, November, December 30th. You don't change the specific date. Okay, you just roll over the number of months. But if it's captured by number of days, that's the tricky one. Okay, number of days, you'll have to calculate specifically how many days are there left in each and every month. And keep in mind that each and every month has different number of days. Remember, January has 30 days. February, we usually assume 28 days, unless it tells you otherwise. March, 31 days, April, 30 days, so on and so forth. And don't forget, July and August both has 31 days. So when we capture the number of days, when we capture the maturity date for the note that specifically states 90 days or 60 days, you actually have to calculate what is the specific day that the note is due. Okay, we'll do an example in the following slide. So basically, if it's a yearly note, a monthly note, it'll be easier. You just simply roll over, add another year, or add a couple of months. You don't change the number of days. But if the note tells you that it's a 180 days note or 70 days note, you actually have to add on the number of days in each and every month to get to the maturity date, the due date. Okay, let's take a look at this example here. Let's say we sign off a note on February 16th, 2014, and the note has a time frame of 180 days. So here's a table of all the days in a month, and you start from February. Number of days, we assume that there's 28 days. Subtract today, February 16th, you have 12 days left in this month, right? So we start accumulated days from 12. Following month, March, there's 31 days. 31 add to 12 gives you 43, so on and so forth. When it reaches the date July, at the end of July, you reaches a point of 165 days. Okay, in this case here is really close to the 180. So the due date for this note after 180 days from February 16th all the way, you will get to August 15th. This is the due date of this note. Okay, the reason why we're doing this is because remember journal entries, when we record transactions, there's always a date, there's always accounts and numbers. You have to know what date to journalize the entry. So typically if the debtor waits until the very last day to pay you back the money, you need to know what day that falls under. Okay? So the beginning of the day doesn't count. The 16th doesn't count. You just use 28 minus 16, find the number of remaining days, and add on to the following months, how many days there are in a month. Accumulate to a point that is very close to 180. Figure out the date that gets you the 180th day. That will be the date that the note matures, the due date of this note. Okay, let's do an example together. Let's assume that there is a 60-day note signed off on March 2nd. So try to do a quick calculation here. What is the maturity date for this note? What is the day you will need to journalize this transaction when you collect the money from debtor? Would it be April or May? Okay, so first of all, tell me how many days are there left for March? 29, right? 31 days, subtract 2, 29 days. And then in April, we have how many days? 30 days. So 30 plus 29 gives you 59, which is really close. Then you have one more day. So the maturity day would be May 1st. Okay, it will be on the 60th day. So once you get to the accumulative day 60, that will be the day that the note matures. So the first day, March 2nd, doesn't count. You just count the remaining days, 31 days minus 2. So you have 29 days there. April, you have 30 days, adds up to 59. Then you have one more day. Okay, if it's 61 days, then it will be May 2nd. 63 days, May 3rd. Okay, once you know when is the time to journalize this entry, once you receive the, of course, in the middle, if the debtor pays back the money on a specific day before this date, then that will be the day to journalize the entry. Otherwise, if they wait until the very last day, this will be the very last day. Okay. So once you know the dates, the second important thing for notes is that you have to know how much interest has accumulated for this particular note. Once it's due, what is the amount that you'll be collecting other than principal amount? Okay, so to calculate interest, usually interest rate will be given, you can just directly assume that it's an annual interest rate. The annual interest rate is only useful if the note is 1 year long, meaning that earlier that example here, $1,000, you lend it out to another customer, to another company, and you want to collect the total amount of money a year later. Interest rate is 6%, you just use 6% times 1,000. This is an easy case. And what if the note is only half a year long, or 3 months, half a year long, or 3 months long, or 4 months long? In this case, we can't just directly times 1,000. We also have to time the fraction of time. Because the 6% is an annual interest rate. If the note is only 3 months old, you will not be collecting an annual interest from the debtor. You'll only be collecting 3 months worth of interest. Okay, so this second case here, if it's by month, let's assume in this case you borrow $2,000 to other company. Annual interest rate is 10%, but this month, this note is only 9 months long. Okay, the due date is 9 months later, so you will not be collecting 10% of $2,000, but only $150. 9 months over 12 months. Okay, a year there's 12 months. If the note is only 9 months long, then 9 over 12 times the annual interest rate will be the total interest amount that you'll be collecting from debtor. Okay, so basically each and every problem that you see, interest rate, you can just directly assume it's annual interest rate. That's the usual case in the real world too. Okay, so by number of months, 9 months over 12, 150 plus 2,000 will be the total maturity value that you'll be collecting from debtor, $2,150 later on when the entire note is due. In case the note is calculated by days, like the example we just talked about earlier, 60 day or 180 days, even though the 180 and 60 could be determined by months, but if it's specified on the note as days, then we would just directly use the number of days to calculate it. Okay, so if it tells you that it's a 180 note, don't try to translate that into 180 divided by 36 months. Don't do that. If the note is stated as 180 days, 30 days, just use the way to calculate interest for days. So in terms of days, we calculated based on 360 days only. Okay, just to omit some of the decimal points. So usually for interest rate, if it's for a daily calculated period of notes interest, we just use the number of days over 360, not 365. Okay, so this case here, we assume that we're lending out money from our company to others, $5,000. Annual interest rate is 12%. Time period for this note is 60 days. 60 days over 360 will give you $100 of interest in total. So later when this note is due, you'll be getting 5,000 plus 100. This is just assumed. So we usually just use a usual case just to omit some of the decimal points, because if it's over 365, it could be messy when we calculate interest. So usually the case will be just using 360. Okay. All right, we're going over these because later on when we talk about different cases of notes, when we mention issuing the notes, collecting interest, accruing interest, we assume that you know how to calculate all these. Okay, so once you're given the number of principal amount interest rate, you have to automatically know how to calculate annual interest rate or monthly interest rate or daily interest rate. Okay, now this entry here talks about accruing interest at year end. So what happened is that we usually journalize this entry if, if certain notes carries on to the following accounting period. So what this means is that if, let's say, we sign off a note December 1st this year, 2013, and this is a note that has a time frame of 6 months. So we'll carry on to the following accounting period. So keep in mind that at this year end, we always need to do this year's financial statements. Okay, interest, the concept is that interest is constantly rolling as time passes by. It doesn't really have a specific date to say that this is the total amount of interest that accumulates. Really, it's rolling as each and every day goes by. So this journal entry here captures the fact that when it gets to the end of the year, before financial statements, we always want to recognize the part of interest that is considered interest receivable to your company. Okay, just like accounts receivable, this is a cash collection later on. Interest receivable is also a cash collection that you'll be getting next year. Okay, so this case here, this example, assuming that we sign a one-year note, $1,000, borrowed $1,000 to others, sign this note December 30th. Since this is a one-year note, it carries on to the following year's September 30th, right? So when it gets to December, we want to capture the time frame, the interest that has accumulated starting from September 30th all the way to December, the end. So that will give you to October, to November, to December, 3 months of interest to accumulate here. Okay, so this is $1,000 times yearly interest rate 6%. We want to time the time frame 3 months over 12 and journalize this accrual interest entry. So accrued means the accumulated interest entry. This is the interest that we recognize as interest revenue in this accounting season because we signed the note this year. So we signed a note 3 months before. We only capture 3 months of interest here, not the whole thing. Okay, only 3 months. The lifetime of this note, again, is a year. What we're trying to do here is capture this part of the interest that has accumulated as time goes by for 3 months starting from September 30th all the way to December 31st. So there's 3 months of interest that belongs to, that is considered as interest revenue, interest receivable, belongs to 2014. And there's 9 months that belongs to 2015. Okay, we only journalize this entry in this case when there's a note that passes on, carries on, and it crosses 2 different accounting periods. In case that an entire note falls under this entire period, then we don't have to journalize this at year end. Okay, later on I will talk about an example for cases that falls only into 1 accounting period. So basically this is sort of like an adjusting entry. So remember adjusting entries we talked about in chapter 3? At year end, before financial statements, we always want to make sure that all the accounts are up to date. So in terms of notes, we want to make sure interest is also captured in financial statements. Okay, so in a way, you can think of this as an interest adjustments. So we sign off a note September. We recognize 3 months of interest that has accumulated in this year. But this is not an interest that we collected from debtor yet, so this is considered interest receivable. All right, so what happens later on when it gets to 2015 September, when this note matures, when the note reaches its due date, what happens is that this will be the entry to recognize collection of $1,000 plus the $60 of interest. Okay, upper part of this table really is very similar to what I wrote there on the whiteboard. We start from note inception, meaning the creation of the note, September 30th. And when it reaches December 31st, since we need to do 2014 statements, we recognize 3 months of interest. So the first part, 3 months, was the journal entry that we made here. Okay, this is the entry when it gets to September 30th, 2015, when we want to collect the total amount of $1,000 principal amount plus $60 of interest. This is the entry that we would journalize. Okay, so if you take a closer look here, notes receivable relates to just the principal amount. The amount that we borrowed to Holland customer. Interest receivable here, we reverse this, reduce this, because we're collecting the $15 by cash now. And this 15 relates to the previous entry here. Okay, remember all the receivables later when we collect by cash, we need to reduce receivables, just like accounts receivables collected by cash. Notes receivables here, we're collecting it by cash. Okay, so together with interest receivable, the 3 months that we recognized earlier, now we are collecting by cash this $15. Also, we're also collecting $45, which relates to this period's interest. Altogether, the total interest amount is $60, but because this note crosses into 2 accounting periods, we recognize $15 as interest revenue in 2014, $45 interest revenue in 2015. But both amount will be collecting plus principal amount together in 2015 when the note matures. Basically when it reaches the due date of the note. Okay, so for the case that we just talked about, also involves 3 journal entry. You will definitely have one journal entry that happens here, September 30th, when you borrow money to that customer. So that journal entry is the note inception entry. You will have notes receivables, since you borrow money to others, and then you reduce cash $1,000. This is the first entry that happens September 30th. Since this is a 1-year note, when it reaches the end of this year, December 31st, we want to make an adjustment for interest that has accumulated up to this point. So when it reaches December 31st, you have an interest receivable entry. Just recognizing the part of interest that has accumulated for 2014, and also interest revenue. So that will be just $15, the entry that we did earlier, this. Okay, that's the second entry on interest. And the third entry would be this entry. So there are 3 time points: creation of the entry, creation of the notes, and then at the end when we want to recognize the part of interest that accrued, and also September when it reaches the maturity date, the due date for the note. Then we make this journal entry here. So this journal entry means that we're now collecting the total amount of cash, $1,000 plus $60 of interest. And then reversing notes receivable, because now we're collecting it by cash, so we reduce notes receivable 1,000. We also reduce interest receivable that we recognized last year end, the $15. And then also interest revenue, that is considered this year's interest revenue for 9 months, $45. Okay, this is also the most complicated case for notes, if it's a note that carries on to 2 accounting periods. Generally speaking, you only have this journal entry, creation of the note, and then an entry on collection of the note. If it all falls under 1 accounting period, there will only be 2 entries. You don't have to make adjustments at year end if it doesn't even reach year end. Meaning if it's a note that only has 2 months of time frame or 3 months, then you just have September creation of the note and possibly November collecting the cash. Just reversing this previous entry and adding interest, that's all. You only have this first one and the third one. But if a note carries on to 2nd accounting period, when it crosses December 31st, since we're making statements here, we always want to adjust the part of interest that has accrued. Okay, so if we put together all these 3 entries, it looks like this. These are non-new stuff. This is just basically what I just wrote here. You have the creation of the entry, increasing notes receivable, lending out cash, reducing cash. When it reaches December 31st, if this note is still outstanding, if this note hasn't reached its maturity date yet, we always want to accumulate the interest at year end. Okay, remember $1,000 times annual interest rate times time period. Third entry here, when we collect the money, remember it's principal amount plus interest. We always want to, at the same time, reduce notes receivable, since we're now collecting the principal amount plus interest. Okay, so this is the case of loaning out money by signing promissory notes. Now, other cases, companies may decide to simply make sales, but not on accounts receivable, but on notes receivables. So basically, other cases follow the similar structure. The only difference is that perhaps you're not loaning out cash, you're making sales. You're recognizing sales revenue or service revenue. So this is also possible, although not very frequent. In some cases, some companies may decide to, for example, sell household appliances, $2,000, to other customers. So the only difference is that the first entry, you're not loaning money, reducing cash, but you're increasing sales revenue. So we're simply just replacing the cash part in this entry into other types, depends on this situation. So if it's not loaning out money, if it's making sales to customer, then you increase sales revenue. And if this note again reaches year end, then again you recognize interest revenue, interest receivable, just like previous case. Third entry, when it's due, reduce notes receivable, reduce interest receivable, and recognize the part of revenue that belongs to this year. Okay, there's a structure of notes really. If it carries on to 2nd year, it's all the same. You have an inception entry, creating the notes, increasing notes receivable, either reducing cash or increasing sales revenue. 2nd, you always have an interest receivable, interest revenue entry. 3rd, collecting the principal amount plus interest. Okay, make sure when you get to year end, if you want to accumulate interest, you have to count the number of months correctly. Okay, so the first entry here starts July 1st, meaning that the entire month of July also needs to be counted in. Okay, don't skip July, because it's July 1st. You have a whole month to accumulate interest. So don't start from August. You will start from July, August, September, October, November, December. So there's 6 months of interest accumulated when it reaches the end of December. Okay. Okay, some of the special cases for notes, again, you see 3 entries here. The only difference is the first one. In this case here, if we want to, companies may decide to convert accounts receivable into notes receivable. So this is a case that also goes back to the beginning of today's lecture when we talked about uncollectibles. If some of the customers has past due accounts receivable accounts, they can agree with this company to convert this accounts receivable into notes receivable, basically buying the customer more time. But they may be agreeing on to pay additional interest on this. So meaning if an accounts receivable was due September 30th, they may decide to convert this into notes receivable. They have an additional time period to collect the money to pay back to the company, but at the same time this will start accumulating interest for this note. Okay, so what these 3 entries is trying to do in the first one here, we are reducing accounts receivable and converting it into a notes receivable, $5,000. Okay, this happens because earlier there was an outstanding accounts receivable there, $5,000, and we're now switching it into notes receivable. That's what's happening in this first entry. And then the second one, again, just a regular interest accumulation entry. You have 5,000 times 12% of interest rate, assume it's 12%, times 42 days over 360. So this case here tells you that this note is calculated by days. It's a 60-day note. So when it reaches December 31st, we want to calculate how many days has passed in order to get to the total amount of interest. Right, so November has 30 days. So 30 minus 19, you'll get 21 days for November, right? I'm sorry, 11 days for November. And December you have 31 days. So 11 plus 31, you get to 42. You calculate interest 42 over 360. Now third entry, again, just like others, when the note matures, when we collect it, it'll be 5,000 plus the total amount of interest. So this slide we talked about converting accounts receivable into notes receivable. Some cases in some of the companies may also do the other way around. So meaning that notes receivable also has a due date, a time frame. Now what if some of the customers do not pay notes receivable on time? So in this case here, this is called dishonored notes. For some of the notes that has past due, this is called dishonored notes. Basically past due notes. Past due accounts receivable, usually we call it bad debt accounts or uncollectibles. Past due notes, we call it dishonored notes receivables. So this is an example here, assuming that this customer has this company has a 6-month note that has 10% interest rolling, $1,200 sign off to another customer. And now it defaults, meaning that this customer didn't pay this notes receivable principal plus interest after 3 months. So in this case here, a company has the right to convert these notes receivable also into accounts receivable. Okay, so meaning these two actually could be switched around if the company decide to do so. They can decide to write it off, turn the case into debt collection company, or they can decide to switch them around and also buy customers some time to pay back the money. Okay, so earlier the case was uncollectibles transferred into notes receivables. This is the other way around. Converting the notes that is due, $1,200 plus 60, all together into accounts receivable account. Okay, so it states that creditor can transfer notes receivable into accounts receivable and then bill the customer for this accounts receivable. So this again, if it turns into accounts receivable, it gives customer additional a month or a month and a half to pay back the money. So when it's being converted to accounts receivable, don't forget to consider interest. So usually the problem will directly tell you what is the time frame for the note earlier. If it was a half a year note in this case, then $1,200 times interest rate times half a year of interest period is the total interest amount. And you plus the principal amount, that will be the total amount that will be converted to accounts receivables. Okay, so for notes, companies can either sign off notes when they loan money to others, or they can also sell products to others by signing off notes receivables. Remember, the only difference is that the credit part, the first entry notes inception, credit part could be cash, or the credit part could be sales revenue. In some cases, they may want to convert accounts receivable into notes, then this credit part will be accounts receivables. Okay. Other cases, if notes also past due, they didn't collect it on time, they can also convert this into accounts receivables. So this is really the call for the company. They can decide to do this or decide just to continually pursue the money from customer, but they have an option to do this. Okay, let's work on an example together. Okay, try to journalize these two cases here. Tells you that this company lent $110,000 to this customer on a 90-day note. Okay, notice this is counted by days. 90-day note, the interest rate on an annual interest period is 9%. First entry, try to journalize the note inception entry. Okay, lending this money, how do you journalize this on June 6th? And then B, try to journalize collection of the principal and interest. Okay, so if this is a 90-day note, June 6th, that means it doesn't crosses on to different accounting periods. It's only about 3 months away. So you don't have this journal entry. You only have the first one and the last one. Okay, so try to journalize these two. I'll give you a couple of minutes. Okay, this problem will be very similar to what we just covered. Besides that, since this is a note that doesn't pass on to another accounting period, so we don't have this year-end adjusting entry for interest. Okay, the first entry here, June 6th, we'll be journalizing the debit side, notes receivable, since we created the note, and then lend out money, $110,000. Okay, so this is the first one, note inception. In terms of the second one, when it reaches collection of this money 90 days later, can you tell me what is the due date for this note? On June 6th, 90 days later, what is the date? September 4th, exactly. Okay, so you have the due date here. You know when to journalize this, and the principal amount altogether is $110,000, but the interest rate is 9%, right? 9% is a yearly interest rate, and the date is 90 days over 360. Okay, since it's calculated by number of days. So altogether, interest will be $110,000 times annual interest rate times 90 over 360. So we'll give you $2,475 plus principal amount will be the total amount they will be collecting by cash.